Good afternoon, everybody, and welcome to the first Ureru seminar of 2021. Ureru usually holds about 4 of these seminars a year at UCT, but obviously for COVID reasons, we are holding this first seminar of the year online. The upside of that, of course, is that means that we are able to reach a much wider audience. So welcome to all our colleagues and friends from upcountry and from outside of Cape Town. And welcome to our colleagues who usually attend these seminars live from Cape Town itself. As is tradition with these seminars, we usually kick off the year with an overview of the property market, looking at the current and future trends, and this year is no different, although I think with COVID, we probably have quite a twist in terms of what this story has to tell. Folks, the format for this afternoon's session will be that we will have 2 presentations of about 20 to 25 minutes each. And then we will have a session where I will be speaking to Francois and asking him about the particular trends that he is seeing happening, as well as his response to the presentations. And then once those are all done, we will respond, or we will ask the presenters to respond to the questions which we hope that you will post on the Q&A platform. Due to the technology that we're using and the size of this webinar, we have to do this type of interaction through a Q&A, using a Q&A function. So I just ask you that if you do ask a question, please just perhaps indicate who you would be directing the question to. You could direct it to all parties, but if you have a particular person you would like to respond to your question, please just indicate who that would be. We are also going to be running 3 polls through the afternoon, and there will be a poll posted after each presentation, and then the results of that poll we will present after the following presentation. So in terms of looking at the current and future trends of the property market, we are, as Ureru, very pleased to welcome and to have with us this afternoon Elaine Andrew, who is the Vice President Client Coverage at the MSCI, and she will be giving us an analysis of the SA property sector. And then following that, we have Craig Smith, who is the Head of Research at Anchor Stockbrokers, who will give us an overview of the listed property sector in South Africa. What I would like to say from the start, obviously, is to thank our presenters. Your input is greatly appreciated, and I think we're all looking forward to hearing what you have to say. And considering that we had such a huge response with respect to this seminar, I think a lot of people are looking forward to hearing what you have to say. So perhaps without any further delay, can I ask Elaine to kick off with her presentation? Thank you.
Hi, Rob, and hi, everybody else. Thank you very much for having me here today. I appreciate the opportunity. Let me just share my screen with you. Right, there we go. Okay, so Francois and Rob have asked me to go through some of the key trends and what we've seen in the property industry in the last sort of few years. I'm going to look a little bit more broadly than just South Africa, and we're going to look at some of the overseas or European and UK numbers that we've been seeing, because it's been quite interesting to watch the trends that are happening there, particularly with COVID. We're seeing some of very similar trends happening here in South Africa. Right, so let me just start by introducing MSCI for many of you who don't know who we are. MSCI is a global American or a US listed company. We have a number of different arms. We look at indices, we look at analytics, we look at real estate, where we're going to be talking today, and we also look at ESG research. So fundamentally, we look at shining a light onto investment for investors, and we try and help them to better unpack and make investment decisions. Okay. In real estate in particular, globally, we cover about 30 markets across the world, and that's about $2 trillion worth of real estate. So really, we're in most of the developed markets, and we're starting to move into some of the more developing markets. Last year, we actually released an index in Brazil, which was nice to see. If we look specifically at South Africa, at our work that we've done here, you can see we believe we cover about 2/3 of the investment market. The data that we're going to be looking at is always looking at directly held, ungeared real estate assets held by both listed and unlisted funds. So we're not just necessarily covering the listed fund market, we're also covering the private real estate market. If you look at the logos on the screen in front of you, you can see that there's a number of smaller private real estate players. A lot of the larger listed funds are here, and some of the older life and pension funds like the Liberties and the Old Mutuals are also part of our data set. So we try and cover as much of the market as we possibly can. Right now we're sitting about 450 billion rands worth of property data within our data set. And by that estimate, we believe that we probably give the best have the best data set with which to run these trends. As I move through this presentation, I've probably got about 20 slides to show you a whole lot of stats and graphs. But I'm going to try and show you 4 key sort of drivers or trends that we're watching in 2021 as MSCI. Again, like I said, not just here in South Africa, but across the world. So first of all, we're going to look at the disruption that's been sped up by COVID. And we can look at a number of different factors within that. So looking at loss of income, we can look at free foot traffic and how that's decreased over time. We'll look at bad debts and vacancies. These are all indicators of disruption happening within our market. And we can probably sit and debate ad infinitum where we think offices may go, where we think residential, how the residential market's changing, maybe where people want to live. Are they moving out of cities into more sort of dispersed areas, or are they, staying where they are? But if we start looking at the actual numbers underneath it, as things are changing and changing more quickly in the last year, we can start to make some proper investment decisions around where we think investment, or what we think, which property types we think will render the best investment going forward. The second trend is looking at amplified polarization of markets and the divergence that we're seeing between sectors and property types. We're also going to be looking at some of the spread that we see within the property types, and I'll talk a bit more about that when we get there. The third and very big item that everybody's watching at the moment is pricing, or as we often call it, valuation. So investors are very careful at the moment around what valuations are and what methodologies are being used to value assets. As we've seen values fall over the last sort of 18 months globally, there's a lot of question marks around are we overcorrecting, or is there still correction that needs to be made? And how is the lack of information or transactional evidence obscuring those values at the moment? Just before this call, we were talking about it, and it's quite hard sometimes to make those decisions in a market where we're not seeing assets trade all that much. And fourth, we're going to look at climate risk. Now, increasingly, there's been a need to include climate factors or climate analysis in the investment process. And that's because it's really hard sometimes to understand or qualify the risks that are associated with climate and that are not necessarily financial in nature. And I'll talk to that a little bit more as well. Because I'm going to start at the beginning, pre-COVID, before 2020 sort of came in, and we looked at some of the markets. This is looking at total return in local currencies. You can see some of the European markets to the left-hand side, South Africa, and then we've got the UK and the States, and across to the right-hand side on the screen, we've got a global return number. And you can see that for the 5-year annualized return running up to 2019, returns were higher than what they actually were in 2019. And that's really showing us that there's been a slowdown in real estate direct property returns globally, particularly highlighted in the UK and the US, which certainly are the biggest markets that we measure. Similarly, in South Africa, we saw returns come off from the previous 5 years to 2019 itself. If we look then just at some of the returns then spread across those European markets, and we go into 2020, this data runs up until June 2020, you can see how returns came off last year. So you can see across the different sort of groupings or regions, we've got continental Europe dropping down to 5.8, and we've got the UK at June of last year actually giving us an annual return of minus 1.2%. So COVID definitely had a big impact on the returns in last year, and that was really due to 2 things, which was loss of income, but also a weakening in the yields. So this is talking to loss of income. And here we're saying, if we look across the different markets, we can look at what the income return. Now, your income return is effectively the ratio between the income and the capital deployed. So what does it cost you to actually generate an income stream? And you can see in 2019, that income return was much higher than it was to June 2020. And that's really telling us that the loss of income or the decrease in net income was happening faster than the decrease in valuation that we saw. So if we're looking at markers to say, are valuations globally sort of where at a point where they're now rebased and we're going to move forward and increase, or are we going to see values come off a little bit more in order to come to the same or be at the same rate of income or match the income stream, should I say? That's probably to say we're going to see a little bit more of devaluation going forward. And this was to June, which we did see in some of the UK numbers, which I'll show you now. All right, so this is looking at the UK specifically. Now, what's nice about the UK is their data comes out quite early. You'll see when I'm talking a lot at the South African numbers, we're only looking until June of last year, and that's because we haven't actually got the December numbers out yet. They only get released in April because we wait for each of the funds to sort of release numbers now. So we hinged on valuation frequency and so on. In the UK, things happen a little bit more quickly than the rest of the world. So here we're looking at the returns, but we've broken the returns over the last sort of 20 years down into income return, which is the yellow bar, the yield impact, okay, which is your change in yield over time, and the rental growth, right? The rental growth, that blue bar. And if we look at the sort of 2008, 2009 point, that was the global financial crisis, you can see the yields weakened significantly going into 2009. And rental growth also came off. But what happened at that point, as the denominator almost decreased of your income return, we saw the income return increase because net income was still growing. But if we look at our crisis that we're facing now in 2020, we see our income returns sort of holding steady through 2019 and 2020, but we're seeing those capital growths, in other words, driven by negative rental growth and negative yield movements, holding down those capital growth numbers. So a slightly different scenario than what we saw 10 years ago during the global financial crisis because of the loss of income within the properties at the moment. Staying with the UK for a minute, we're looking here at net operating income growth, and you can see its volatility through 2020 as it went into COVID. You can see that number on the left-hand side graph. That's a 12-month net income growth number, dropping down to -5% by December of 2020. So a huge amount of income being lost through last year. On the right-hand side, we're looking at 3-month net income growth numbers, so we can look at that on a quarterly basis and splitting that then into the various sectors in the UK. You can see how in June, when COVID was probably playing out most in terms of the income stream and renegotiations of rentals, you saw massive declines in net income growth. That sort of picked up a little bit or steadied a little bit in September, and then we saw a little bit of growth in 2020 over the last quarter. And that was probably coming off a low base that we're seeing that growth. But if we look at the different sectors within that, retail being that dark blue bar has certainly been the worst affected. Hotels also being quite badly affected, but then recovering in December. Now, if you remember, one of the themes I talked about was that amplified polarization between the sectors. Here we're looking back at a global picture. So we're looking at global returns split up by sector. And you can see the red line on the top was the industrial return. And you can see back in 2013 already that started to disconnect from the other sectors. And back then already we were starting to get better returns from industrial. So this is not a new trend. This has really been something that COVID has accelerated and something that we are watching very carefully to watch as this polarization between the different sectors widens. What we can see as well, though, in retail since 2017, we've seen retail start to slow down and returning that negative number that was down to June 2018. June 2020. If I go back to the UK where we have our December 2020 data, you can see that split in the different sectors. You see industrial on a 3-month rolling return, giving us a 6.4 in the last quarter of last year, and retail only returning negative 2.3%. Okay. So really a marked effect, and when we start looking at the South African data, the picture is not dissimilar here. Now, I thought this would be interesting to show you, because this is something we're not often able to see within the South African data set, but anecdotally, and something that we hear when we're talking to the listed funds specifically and they put their results out, we are, and when we deal with our clients a lot of the time, we are seeing, we talk a lot about leases that are being signed, and we're looking here at the UK, and you can see on the left-hand side, the number of leases that have been signed in the last year has decreased dramatically. So one of the effects of COVID was leases being signed as just less people are less willing to commit to leases within real estate. And that's the same whether you're looking at office or industrial or retail. And then on the right-hand side, we're looking at the average lease length of the leases. And what's very interesting in this slide is how you can see how dramatically the lease length for retail properties has come down. Probably less so in offices, probably bounced around a little bit, and industrials moved sideways as well. But we can certainly see that retail lease lengths have come off substantially. I'm going to show you Ireland as well, where we recently released results, because I wanted to just bring back to our point of amplified polarization and disparity within sectors, and location and property type becoming a bigger and bigger factor. So within the Irish property market, we look at, we split it by sector. So you've got retail, office, industrial in the screen in front of you. But if you look at some of those subcategories, we've got retail in shopping centers, which is a type. And then we've got sort of high street retail in different locations. And you can see, although all of retail is not performing particularly well, there are some areas that are holding up better than others, and some property types that are holding up better than others. Okay. Retail warehouse is sort of what in South Africa we would think of as a macro. Okay, so sort of more wholesale-y type retail. Okay. Then you also look at the offices in the middle. Again, very similar, but there are some office markets that are not doing very well. And then industrial, again, outperforming. But the point that I'm making on these slides is if you're looking at these different areas and different property types behave differently. Here we can just see, I thought, just to underpin the reason for the downward or the weakening capital growth within Ireland is really driven both by yield weakening and also by rental growths coming off. Okay. If you look across to the right-hand side of the screen and you look at the industrial segments, you can see there that income growth has been positive, yields are still strengthening, and you're getting rental growth. Lastly, I wanted to look, before we turn to South Africa, I wanted to look at the US market. And this data is from June 2020. You can see industrial, just like all the other markets, industrial being the best performing market, certainly with hotels taking the biggest impact during COVID last year, and retail right down there. If you look at the right-hand side, we're looking at quarterly returns on the right-hand side, again, broken up into property types. And the reason we keep doing this is we're trying to understand, are there property types specifically within the broader sectors that are returning or giving us better returns or more resilient as we go into these sort of crisis at the moment, okay, or in the crisis that we're in. And I want to draw your attention to the middle section there, which looks at garden apartments, suburban or high-rise apartments and low-rise apartments. And we're starting to see, and a lot of the talk that we're doing and a lot of the research that we're doing is around residential and the movement of people out of the city into possibly more affordable housing, not affordable housing as we think of affordable housing, but a housing that is at lower rentals, maybe outside of prime office spaces, because there's no longer the need to travel into offices. So the movement of people is quite interesting and will be quite interesting to track over time and what that does to return. So maybe within this slide, we're just starting to get a taste of that, but it'll be very interesting to see, and the necessity to be able to look at data in this granularity is going to be very important in tracking those kinds of changes going through. So let's look at South Africa there. Now, like I said to you, our data in South Africa, the latest data we have at June, we're waiting for the December data to come through. But what we're looking at here is the returns over the last sort of 25 years that we've been measuring property in South Africa, broken down into the capital growth and the income return. Okay. And you can see income return is held quite steady. And then right to the right-hand side, we're looking at a 6 months to June return. We see that capital growth coming right off over the 6 months at minus 5.2% and an income return of 3.7%. So really the impact of lost income being significant on that income return, and the probability that capital growth or that valuations are going to come off some more when we look at the December numbers in April is very, very likely. We can then break that up into different sectors in South Africa as well. And you can see that retail, just like in the UK and in most other of the markets that we're looking at, retail has taken the biggest pounding in terms of return and in terms of capital value write-downs, with residential following suit. And so residential has actually taken more pain than what we probably thought it would through last year. And industrial then holding up as the best sector. Here we're looking at we've broken that down, we've taken that one step further, and we've said, well, let's look at the returns of all the various segments within the market, so we can look at the different kinds of shopping centres, the different sort of locations of offices, and then the different types of industrials. And we see that larger format shopping centres is those that are taking the biggest write-downs. So super regionals ending with the 7.6% capital growth that was over the 6 months to June, with regionals just behind that at 6.3%. And then sort of in the middle there, we're looking at warehouse and distribution, which is part of that industrial segment, and that having a negative devaluation of 2.4%. So really that's the segment of the market that right now seems to be the darling and seems to be holding up better than any of the others. Continue to watch that. Now here what we've done, we've taken that one step further and we've said, right, let's just break that down even further. So let's look not only at segments, but let's look at property types. Okay, so you'll see our offices at the bottom. We're looking at freestanding offices. Those are those green bars. And you can see freestanding offices in terms of return, and office parks have come off quite a lot. We've also got the red bars in there are the industrials. They tend to be towards the top and have done better. We've got residential somewhere in the middle. And then we've got our large shopping centres, which is those big yellow bars in the middle. Now, having painted that sort of sad picture of, you know, these entire market segments or property types like super regional, regional, really taking so much pain through last year up until June. What we're also seeing, what we need to highlight is that it's very important to understand stock selection and the assets by themselves. So not only are we seeing a huge amount of widening or polarity within sectors, but you're seeing that within property types or within a location, very much down to an asset by asset level. So if we just look at the spread of returns by asset, and you look at your super regional shopping centres on the left-hand side, and we take off the top and bottom just for confidentiality sake of our clients, but you can kind of see that spread ranges between a 0% return, which granted is not fantastic, but it's sort of stayed in the same place, down to a -10. So there are winners and losers within a segment. Okay, so it very much matters for the real estate funds, the actual assets that they own. Okay, if you look across to the right-hand side, and this is true for whichever segment, so whether you're looking at the worst performing segments or sectors or property types being super regional, or you're looking to the right-hand side and we're looking at distribution distribution centers, there again, you may have, there's a large spread, some of the worst performing assets getting a -3% return and the best ones sitting at around 6%. So it very much determines also the actual assets is very important within investments. One of the other factors that we've looked at through last year, talking about what the drivers may be within the assets, is looking at the green factors or the mitigation of climate risk. Now in South Africa, we don't have any absolute goals like the Paris Agreement to move towards net zero, but we are finding a lot of the funds starting to introduce and have been for a long time putting in green measures or in their buildings in order to reduce carbon emissions. And that's something that MSCI is going to start measuring more and more in the next few years, so that we can actually make a case, a stronger case for green investing. Right? What we've been looking at up to now is trying to compare on a like-for-like basis whether or not green assets produce a better return. And you can see on the slide on the left-hand side, we're looking at the total return of prime and A-grade offices that are certified, which is those that are not certified as green. And we can see on a 3-year annualized basis to December 2019, the certified offices have given us a better return than the non-certified, because the perception of risk is lower. Okay? The perception of risk in that they're easier to let. You don't necessarily get a higher rental, but they're easier to let. You do get better net income growth, and there are lower vacancies, which you can see in the stats on the right-hand side. So all these factors actually play in to measuring properties at the same time. If we go back onto our net income and we look at a long-term trend of net income across the different sectors, you can see over the last 10 years, sort of coming off from the 2007 through to now, net income has been slowing, although retail probably was the better net income through the mid-teens. And here we look at net income numbers. And really the reason that we're looking at net income is because net income is what drives the valuation of the assets at the end of the day, or what technically should drive it. So if we look at our distribution centers, why have we had better capital growth or less devaluations in our distribution centers? And you can see the net income over 2019 was still growing at 6%, and even year on year to June 2020, it was only down 1%. Looking at the super regional shopping centres, as an example, which is fourth from the top, there in the previous year up to December, it was still growing at 4%. And then fair enough, you see the effect of COVID coming in drastically there, and that being written down significantly. So really you are seeing that net income is driving, is the decision around, or a lot of the valuation decisions that are being taken at the moment. So what we tried to do was track or look at how successful our property funds in South Africa have been at aligning their valuations with their actual net income assumptions within the valuation. Okay, and so we indexed this up from 2018, and you can see that these two things align quite nicely. So the growth, or your asset value growth number, or your valuation growth number, has tracked at very similar rate to your net income growth number. In fact, your net income growth has always been slightly faster, which is positive. So if we're answering the questions of how overvalued are our properties overvalued, they probably weren't significantly overvalued if we look at them starting at 2008 over the last 10 years. Okay, and then we look at what's happened in the 6 months to June. As you see those net incomes drop off significantly, we have seen property values also come down, which is encouraging when we're thinking about valuations and how much and what the pricing has actually done, and are we at the right point? Have we overcorrected? Are we still correcting in line with income? So, you know, talking about sophistication and valuation models, MSCI has a valuation, a sort of modeling tool, which allows our clients to try and look at the various parts of a valuation. So looking at short-term income impact, looking at longer term, looking at sort of risk profiles. What are the discount rates? What is the long bond rate? How do you decide on what those things should be, to try and assess in a far more sophisticated way, rather than just slapping on a cap rate, to understand if we tweak different parts within our valuation model, what does that do to our value, so that we're far more accurate within the valuations over time to be able to track the income stream. I wanted to show you vacancies. If we look at vacancies, it's one of the other very important markers within, you know, real estate to know where we're going. We're looking at vacancies increasing. We know that office vacancies have actually increased substantially. This data is up until December. And then we look at the June numbers, again, broken that right down into those different property types. On the left-hand side, I've got distribution warehouses. So we are seeing vacancies generally go up in most categories or most property types, but really quite low in distribution warehouses. Offices, if you look at those two property types on the right-hand side, right up, climbing up to 14%, and probably going up to much higher than that by the end of this year. We also can look at the rentals. So the way that we looked at the data, we tried to split out what was a COVID discount given on a short term, and then what was a actual rental change, to look at what was the base rental that the landlord is expecting the tenant to pay over time, without the COVID discount being an impacting factor. And what we saw in the market last year was an enormous renegotiation of leases, often extending the term but starting it again at a lower lease, and that sort of took away some of the risk factor for vacancies. But on the other hand side, it sort of knocked that base rental right down. And this was true across the market. Probably most we saw this, most pronounced in retail and less so in residential, but we sort of see that renegotiation of leases with a negative rental growth as reversions of leases have been negotiated downwards. The other thing that we're looking at quite in detail is bad debts, and we are seeing those ticking up, although at that point in time, and this is looking at December, at this point, and then we look at across to June, and you see it's only 0.9% of the total income for retail, and 0.8 for industrial, and 0.6 for offices. So bad debts at this point are being managed quite well by the funds. We're not seeing enormous amount of bad debts coming through, although I do expect that this picture is probably going to change. If we look at the periods of sort of 2001, when we had crisis before, 2009, bad debts were a little bit higher. So we can expect that those are probably going to go up to similar sort of levels. But that sort of brings me to the end of our conversation around this, the trends. And I hope that I've sort of highlighted just some of the main things that we're looking at. So looking at the COVID disruption and the fact that that COVID has really not caused the disruption, it's just accelerated us down the path that we're already going on. And we'll continue to measure vacancies and income growth, bad debts, because that's really going to help us understand how this disruption settles over time, or where it might settle, or what the new norm may be. I guess that's the question on everybody's mind. We also continue to monitor this polarization and look at factors. And some of the things we're starting to look at more and more from investments is looking at what are the factors that influence real estate investment. So, we're looking at things like property type, location, climate risk mitigation, tenant covenants, and quality, because each of these things, when you look asset by asset, play a role within the returns that asset derives. And then lastly, looking at pricing and valuations, and we're really watching this, not only us, but investors and lenders across the spectrum, because it really, real estate is rebasing at the moment. So to set those prices at the right point from which to build is going to be very, very important, and really increased transaction activity in 2021 is going to help us a lot in informing those valuations and knowing what point to set them at. Right. Well, thanks very much, everybody. I'm going to hand back to Rob and take any questions, Rob, after this.
Thank you very much, Elaine. And that data and very detailed data raises many questions that I can already see are starting to come through from the participants, etc. So that's fantastic. So thank you very much for going through that in such a systematic way and clear way. Just to remind everybody, we are going to get to the questions, but we're going to get to the questions after we've finished the presentation. So please keep them coming through. Please just, if you can, just direct them to particular people if you want somebody specifically to answer them, or just say that this is open to the entire panel. Please, folks, we also will be posting a poll shortly, just a very short poll. So please but respond to that poll, and we'll post the results after Craig's presentation. Just a couple of other questions that have come through, folks. We are recording this session, which sorry, I should have probably said that right in the beginning, but and we will then post this recording on the Ureru website afterwards, so you will be able to access it there as well. Craig, then just in terms of the interest of time, if we could proceed with your presentation. And just a reminder, everyone, that Craig is head of research at Anchor Stockbrokers, and he's going to be focusing specifically on the listed property. which I think is going to be great because there've been a couple of questions about the differences between the listed and the physical market. So hopefully after this we'll have a better insight in that regard. And just a reminder to please look at those polls, etc. Craig, thank you very much once again, and we're looking forward to your presentation. Thank you.
Perfect. Thanks, Rob. Thanks for the intro. I just want to confirm that my presentation, you can view my presentation.
Yes, I can see it.
Okay, great. So, good afternoon, everyone. Just as Rob mentioned, I work at Anchor Stockbrokers, and my focus is on the listed property sector. So I'll spend the next sort of 25 minutes going through my presentation. So just to quickly emphasize that the reality over the last sort of 10 years is that the JSE property sector is one can no longer sort of see it as a pure proxy for the SA property market. I think that's as a function of the fact that a large exposure now resides outside of South Africa. So a number of our larger listed property companies and REITs have invested abroad into other markets, starting from around probably 10, 12 years ago, and that accelerated probably from the early 2000s onwards till about the mid to late 2010s. So you can see, I mean, these two charts or these two pie graphs sort of summarize that, where it's quite clear that there's sort of a split now between SA property and offshore property through what one gets by investing in the JSE as a sector, listed property sector. It's about evenly split between SA property and offshore property, and predominantly the exposure has sort of taken place outside of SA in Central and Eastern Europe, the UK, Australia and continental Europe to a lesser degree. And just to maybe touch on probably two reasons behind that. The one is a function of the fact that the SA property sector, the physical property market, has been quite challenged for a number of years. In terms of administered costs outpacing inflation, certainly outpacing market rental growths within the various sectors. And then secondly, the reality is that our REIT sector is, for a developing market, it's quite a mature sector, and some of these REITs have almost outgrown their home market. So companies like Growthpoint and Redefine. Growthpoint sitting at an asset base in excess of around, call it $10 billion US. And the reality is that it's very difficult for them to make meaningful acquisitions in the SA context. And that, as I mentioned, is a function of the fact that our REIT market is sort of disproportionately represent, or I suppose if you look at other markets, in the US and Europe and even Asia, you'll find there's definitely more of a sort of balance to the market in terms of pension funds, private equity investors, unlisted funds, family offices, and REITs. REITs certainly have a role to play, and in other markets you've got unlisted REITs as well. So I think that potentially creates a bit more liquidity in the market. So REITs are typically long-term holders of assets. Their business is to hold assets for the long term. Obviously look to recycle at sort of the right points in the cycle. But what that does create is a sort of buy and hold strategy for the most part, and it has an impact in terms of liquidity. Then just to maybe touch on very briefly, I think where we've sort of come from. Our market, we've actually, I mentioned we've got a mature REIT market relative to other emerging markets, and that's partly a function of the fact that we had a REIT-like structure from sort of the early 80s through our property unit trusts, which preceded the REIT framework, and more recently, prior to that, the property loan stocks, which effectively gave the ultimate investor in these vehicles a similar sort of outcome, certainly from a tax consequence point of view. But REIT legislation was only obviously formally adopted in 2013. But what had sort of happened up until about 3-4 years ago is that the listed property sector was consistently one of the best, if not the best, performing asset classes on the JSE over sort of short, medium, and longer periods. Part of that was a function of interest rates coming off significantly higher levels towards the late 90s, and property benefited as bond yields moved down, and as sort of property as a became, I suppose, more actively managed, and REITs were seen to be able to extract value where certain assets were held in sort of life companies and pension funds. But the search and the hunger for yield and sort of short-term distribution growth, almost led to sort of decisions and behavior which was short-term in nature, and in terms of the benefits, and that drove elements of financial engineering and other activities to sort of supplement distribution growth that these REITs and all these listed property companies could generate for shareholders, and that eventually unwound. I think as the local market came under increasing pressure, property values started to come under pressure, as Eileen has touched on. That's almost created the perfect storm for listed property over the last sort of 2-3 years. Even prior to COVID, the listed property sector had 2 very challenging years prior to last year, on the back of elements of non-property related activities, or rental income related activities, which were not sustainable over the long run, and then concerns as well around governance. So again, touching on what Eileen spoke around, the ESG aspect. So that's sort of where we are. I think it's still probably too early to say whether there has been a complete refocus in terms of how investors and property companies will sort of turn things around and manage their businesses going forward. But I would like to believe that there will be a stronger sort of focus on longer term sort of value creation and a total return conversation, as opposed to purely a yield and accretion, without looking at the other side of the equation, which is the risk component. Just to touch on some themes that we experienced in 2020 in the listed property sector, front and center would be, top of the list would be the pandemic, and that obviously had a massive impact on earnings for the REIT sector, as certain businesses were had to for intents and purposes had to stop trading in some instances, and business failures obviously increased, and that placed significant pressure in terms of a short-term earnings void for a lot of these REITs. And the question, I suppose, is to what extent that is going to translate into a longer-term rental level adjustment and potentially higher vacancies. Secondly, reduced payout ratios, and I think that's that was probably coming irrespective of the pandemic. I think the pandemic just brought that conversation to the fore a lot sooner. So I think as companies are have had to give rental concessions, and rents have in some instances gone backwards and vacancies have increased, managing your balance sheet and your liquidity has become the order of the day. And one way a REIT is able to sort of manage their their liquidity profile and strengthen their balance sheet is by retaining earnings. So REITs have to distribute a certain minimum percentage of their distributable profit in order to maintain their REIT status. And that level is set at 75%. If you went back historically, it was very much an anomaly where in our market, traditionally most REITs paid out 100% of their distributable profit. And I think, looking at other markets, and I suppose it's easy to say in hindsight, but the reality is property requires capex and investment over the medium and long term in order to allow those properties to sort of grow at a rate in line with inflation, or in line with market rents of new assets. So we've seen a lot of companies adopting reduced payout ratios. In some instances, we've seen more recently certain companies embarking on sort of deeply discounted reinvestment options for shareholders in exchange for the right to receive the cash distribution as a mechanism to hold on to distributable profit and earnings. And more recently also we've seen a handful or less than a handful of companies actually taking, or the board taking, the decision not to make a distribution on the grounds that they weren't comfortable that the company would meet the solvency and liquidity test. So REITs are still able to maintain their REIT status if they don't make a distribution, but only on the grounds that it's on the basis of not meeting solvency and liquidity tests. So that we've seen come to the fore, and I would expect a combination of discounted reinvestment prices through a DRIP, dividend reinvestment program, or potentially not paying dividends in the short term due to solvency and liquidity tests. There's an increased possibility that becomes sort of more sector-wide outcome. Then and like I mentioned, a lot of the reduced payout ratios were as a consequence of stretched balance sheets and liquidity, as we've seen asset values being written down. And I think there's sort of broad consensus that one expects further write-downs over the next couple of years, or certainly over the next 12 to 18 months. And that obviously places upward pressure on one's loan to value. And it's become sort of very.
Sorry, I'm having trouble hearing you.
Sorry, it's become very apparent that the order, or everyone talks about property, it's location, which I think for physical property is certainly still the case, even in a world of disruption and digitization. But for a REIT that owns property with gearing, liquidity is certainly equally as important, because it allows you to avoid doing having to enter into transactions which are actually value destructive at a point in the cycle where you should actually be instead in a position to hopefully look at capitalizing on some distress and having the dry powder to pounce. I think just something I haven't touched on, I mean, one can say that landlords and the listed property sector certainly came to the party during the pandemic. Sort of latest estimates are that approximately 3 billion has been provided in terms of rental relief and concessions in order to keep a lot of businesses afloat and help with their own sort of internal liquidity as well. So I think one can say, well, there's always this sort of tension between landlord and tenant. I think that was certainly an example where the property sector as a whole, and their customer, being the tenants, certainly worked closely together. And I think a lot was achieved during those sort of collaborations. Then all of this has led to a number of stocks, or the sector at large, trading at a deep discount to the underlying net asset value per share of these companies. And again, everyone's going to have a sort of different view. Either this is offering deep value, or it's a value, potentially a value trap, certainly in the instances of certain companies. And then lastly, I think what we've seen is that, not all property types have behaved the same during the pandemic over the last 12 years, and even prior to that, leading into the pandemic. One can see that sectors like logistics, storage, even though retail's had a lot of negative press, and I think, as a general comment, retail is under, I suppose, pressure, in terms of increased e-commerce and the like, but certain subsectors within retail have actually been extremely resilient over this period. So, for instance, convenience, community retail, rural township retail has also, held up nicely. I suppose affordable housing is in there because I think that market, in some instances, if you look at companies like Transcend and certain other companies, you can see that there has actually, some of those. The affordable housing space has actually held up has actually been fairly resilient during this period. And I think over the medium to longer term, it definitely offers, massive opportunity, just given the shortfall. I suppose the challenge is always, and it sounds simple, but it's to draw in, the private sector and private capital, but then also to, find solutions to provide the right product at the right price point. I think also maybe just to, while I've sort of mentioned that around retail, I think, I would certainly be a sort of supporter or confirm the fact that, rural and township retail has held up, certainly better than retail as a whole. I suppose the question is, while essential tenants have sort of certainly benefited, in terms of their sales, and they've traded extremely well. So the likes of your grocers and your pharmacies, etc. But I think the key question is sort of more medium, even short to medium term, is the impact of this crisis and the impact in terms of jobs lost, in terms of the ability of those retail centres to provide space for their line shops at rental levels that those tenants can afford. So while the consensus or comments are rural township retail has been extremely strong, I think some of that was due to potentially temporary sort of government support through additional grants. So there was more liquidity in the system. But going forward, unfortunately, as nice as it is to have some of these big anchor tenants and these essential retailers, I think they are key, but they don't typically pay your rent and your return. So it's usually your mom and pops and your line shops. And I think in a situation where employment, or unemployment levels increase and there's more pressure in the system, to what extent those tenants are able to actually pay you, the rents that are currently in place. Then something that is interesting to track is obviously what's happening globally in terms of the vaccine rollouts. I think a lot depends on the sort of the rollout strategy and the efficacy around vaccines. I think two countries which will give us sort of an early snapshot of how things potentially could look like in a sort of new normal is Israel and the UAE, just given that they're so far ahead of any other country in terms of rolling out their vaccines. So I think those are sort of two interesting countries just to keep an eye on. Again, I mean, I think, in order for this to for things to ultimately sort of normalize to, whatever that new normal looks like, the reality is that with sort of migration and global travel, we're going to have to get to a point where many, all geographies and all countries are, at a point where they've reached some level of sort of herd immunity for it to not be disruptive. Then I think I've touched on this. So this slide sort of just gives a snapshot of, reported distributable income per share growth, and you can just clearly see from the earlier points I mentioned that there's been significant pressure around distributions, and again, it's a new metric. I mean, before we would always talk about distributions per share because effectively, companies would distribute 100% of their distributable profit. As companies have introduced payout ratios, another metric to look at is distributable income per share. LTV ratios that, I've touched on that, stretch balance sheets, and this just gives some sort of indication of LTV ratios within the sector versus, these companies or these REITs, strictest LTV covenants. I think these LTVs, I mean, if you were a private investor, I don't think these LTVs would be particularly concerning, sitting in the region of, let's say 40 to 50% band. That's not overly concerning for most private investors, but the reality is that globally, there's sort of a accepted norm that gearing, ideally should sit between 30 and 40% for a REIT. And I think that's very much a function of the type of risk that someone is prepared to take investing in a REIT. They want, certainly they want property exposure. I suppose as you go and you introduce more and more debt, you become a lot more equity-like, and I think obviously introduces a lot more variability in terms of your earnings, especially in instances both on the up and on the downside. And we certainly in the down or in the challenging space with rising loan to values and the impact that potentially has on sort of longer term shareholder value. And again, I mean, the point I've stressed earlier is that optically these numbers may look fine, but I suppose the big question is how much further do values have to decline. So, sitting at a 40% LTV doesn't look that concerning, but again, it's in the context of REITs sort of optimally having gearing between 30 and 40%, and that's what investors ultimately are comfortable with for the most part. But if you start having sort of significant declines in values, call it 15, 20% declines in values, and your LTV is sitting at 40%, that can have a significant impact in terms of movements in your LTV, and then you suddenly run into issues where you breach LTV covenants, and the bank sort of becomes certainly a lot more sort of prescriptive in terms of how one sort of manages capital allocation and in terms of potentially having to dispose of assets at a point in the cycle where you probably you don't really want to be a seller. So again, I mean, this just sums up from a I suppose a relative positioning in terms of LTVs and interest cover ratios. I mean, I won't talk to this specifically, but you can kind of see where different companies are sort of positioned in terms of their LTV and the interest cover ratios, and kind of being in the green box is relatively stronger balance sheets, and in the right hand side less so. And again, I've touched on this point, so this just gives a breakdown of the various listed property companies trading at deep discounts to NAV. You can see that quite clearly through this graph. And then this just gives an overview in terms of movement in property values over the last year for companies in the listed property space. And you can quite clearly see there's been a trend of asset write-downs pretty much across the board, with the exception of three counters. And we would expect there still to be further sort of pressure in terms of valuations. And I suppose Eileen had a really interesting graph around tracking net income growth and that sort of being in tandem in terms of value declines. But I suppose the question is where you get to a point where property fundamentals have been weak for a meaningful period of time, and bearing in mind that typically there's a big component of contractual escalations embedded into your net income number. You only have a percentage of your leases expiring each year, and where your supply-demand dynamic sort of starts going out of kilter from a real estate point of view. I think as leases unwind, you can start to see that, that sort of, I suppose, leverage in terms or difference between contractual escalations and market rents and market rental growth. As that widens, you can start seeing you know, that becoming a lot more meaningful as leases expire. These next two slides sort of, you know, are looking at two different indices, but effectively looking at the listed property sector, the ALPI and the SAPI. They're two indices that most investors sort of track. You can quite clearly see that, you know, it hasn't been a pretty story, certainly over the last year, property being a physical asset, and, you know, our sector still being heavily concentrated in sort of traditional property classes such as offices, a big component of regional and super regional, which, you know, has experienced sort of headwinds globally for a number of years. You know, that sort of culminated in very weak performance over 2020. And, you know, if we went back 3 years ago, like I mentioned at the beginning, you know, this graph would have sort of shown property outperforming every other asset class over certainly longer periods, medium-term periods, and even, you know, traditionally over the short term as well. That's completely unwound. I think if we were to also show this, you know, it's something we used to sort of show when it sort of looked good to do so, but you'd also track volatility and risk-adjusted returns, and you can clearly see over the last 2-3 years, property hasn't, you know, listed property hasn't behaved as a sort of intermediate sort of risk exposure compared to, you know, being a bond, you know, in between a bond and an equity. It's actually been a lot more volatile than, call it, your broad equity markets. And I think part of that is, you know, what we spoke about before, you know, some non-property related activities or non-rental income related activities which supported earnings in the short term, and then also, you know, the fact that leverage has started to increase over time, both as a function of absolute debt taken on board and also as now values start to decline. So that sort of contributed to this. And as I mentioned before, going back sort of 3 years ago, there were sort of certain other issues around governance-related concerns that, you know, the market had towards the listed property sector. And then this sort of summarizes all of that quite nicely. I mean, you know, looking back, you know, till about 2017, you can see that, you know, performance every year was, you know, it's a few blips, but generally, you know, great performance from a total return point of view over many years. You know, and you can see the last sort of 3 years, you know, starting in 2018, sort of big negative returns, and last year, you know, the worst sort of year on record since '95 for the listed property sector. Looking globally, you know, again, I won't spend a lot of time on this, but you can see, you know, also it's been challenged for other markets as well. So this isn't, certainly in 2020, it hasn't been an SA listed property experience. It's been experienced across the board in other markets, but definitely not as severe, because I think in some other markets, for instance, in the US, you've got a much bigger component of it's almost a bit strange not to term it non-traditional real estate, because if you look at the composition of, you know, the US REIT market now, the bulk of, or certainly the most exposure now, you know, it's towards the data center sector and towards the mobile tower sector, and then logistics and multifamily. Those are all sectors which, you know, don't exist in our market. I would expect that to change over time, but it's, again, you know, there is usually quite a long lag between what plays out in, you know, the US REIT market and our REIT market. And I think, again, what's going to make it a little bit more tricky in the sort of short to medium term in our market to sort of experience this change is, you know, some of the players that would have had a part to play in this sort of you know, growth in exposure to some of these sectors. I think, given the fact that they're sitting with constrained balance sheets, you know, they're not really in a growth mindset, or don't have the available you know, capital to move in a meaningful way into those sectors. Then quickly, I'll run through this quite quickly, but looking ahead, so, you know, what sort of to expect in 2021 and beyond. I think, you know, I've touched on a number of these points, but, increased focus on balance sheet management. So I think that's sort of the order of the day. For a REIT, it's all about liquidity. So reduction in LTV ratios, disposal of non-core assets, and while it's probably what most management teams would like to do, the reality is in this market, there's potentially increased possibility of selling some core assets to bring down, one's LTV. Reduced use of cross-currency interest rate swaps. I think we've already seen that sort of playing out over the last 12 to 18 months. And I mentioned lower payout ratios. We touch on that. And the second point, property valuations. We see further impairments over the short to medium term. Increased sort of repurposing of space, so either via conversions of assets in oversupplied sectors. So, for example, in retail and offices, one could expect, certainly in offices, potentially some repurposing to residential. And then, also question mark, but, potentially some of these traditional, I suppose, retail or leisure assets, maybe opportunities from a storage or, in some instances, data centers or mobile towers. And then also, continued sort of optimization of more resilient sectors. So last mile logistics is a big one. No one sort of got that right yet, but that's certainly a trend globally. And then, Eileen also spoke around this in terms of looking at, lease terms in the retail space, also declining over time. We would certainly see a shift towards shorter leases. Certainly, that being sort of pushed more aggressively by tenants across the board, I think, from, outside, offices as well. And certainly in the retail space, I think a bigger push towards turnover or more of a heavy, a bigger link to turnover-based rents. And then the question around escalations. I think, South Africa's also been a bit of an outlier globally in terms of our sort of historical norms of escalations being sort of, fixed within a fairly tight range and at a high level, especially in an environment where inflation in SA and globally has come down substantially. So potentially further pressure from an escalation point of view. I know, the counter will always be, well, someone, you need to make it up somewhere. So, you'll look to rather, increase your base rent. But I think it does sort of create this situation in South Africa where you have this massive disconnect between longer dated leases escalating at these sort of non-inflation linked escalation, certainly, at this present point in time, and where market rents are, for all intents and purposes, either flat or going backwards, not even in real terms, in some instances even in nominal terms, and that just creates this massive likelihood of big reversions on expiry. And then I suppose increased vacancies we would expect. I think that's an expectation, either a combination of increased vacancies or further rebasing in rents as landlords look to retain and keep tenants. I think all of these, things, around work from home, flexible working, I think ultimately that puts further downward pressure on office demand. I suppose the one saving grace is that, one would expect development activity to slow down, certainly in a meaningful way over the next, couple of years, and potentially as some space gets repurposed to take some stock out the system. But I think, bottom line is for a sector like offices and general comments around retail, I think, probably, has a longer term impact in terms of a reduction in demand. I'm not saying that there won't be certain types of retail or certain locations that won't do well. I mean, I think that's certainly going to be the case, but I think, again, Eileen mentioned that, expect to see this bifurcation or this sort of, divergence, potentially increasing not only between different sectors, but within certain subsectors as well. And then just to wrap up, I think this sort of gives a good sort of snapshot of what sort of played out over the last 12 years, and I think things that investors in the physical property space and in the listed property space are all thinking about, and ultimately this is going to have an impact on the built environment and the demand for space and sort of the readjustment in terms of demand for different types of properties. So that's it. Sorry. Then last but not least, certainly, just a quick snapshot on I suppose an ESG related topic. I think if you look at a breakdown of both from a gender and a race point of view in terms of splits at an executive level, I think it's quite clear to see that there certainly has been progress that's been made, but I think still a lot more progress to be made. And we've specifically honed in on executive directors because I think if you look at the stats for non-execs, you typically find that certainly looks a lot more, maybe not representative, but certainly a lot more representative than it does from an executive director point of view. So I think a lot more work still to do around gender and certainly around race as well. And this ties in very much to the ESG theme, which isn't only environment. It certainly is around diversity, and other aspects as well. So that's it from my side. Thank you.
Thank you very much. I said I'm always impressed by your ability to give so much insight to what's happening behind the numbers. The numbers are interesting, but your commentary of what's driving those numbers is just always so insightful. So thank you very much. And in the process, you've actually answered many questions that a lot of the participants have been putting on the Q&A, and you'll see quite a few of them have been directed at your presentation, which is great. Just a reminder that we will give both Elaine and Craig an opportunity to respond to the questions after we've had Francois' input. So please continue to post them. Also, folks, just remember that we're running a number of polls. We're going to just present the findings of the first poll. And once those findings have been published, we'll put up the second poll because it's really interesting to see what your views of the world are as well. And I see the poll has been quite active as well. So perhaps maybe that's what we should do now, is to see what the rest of the world thinks about our questions, and perhaps we can post those results of the poll now. Thanks, Roxanne. So basically the question was, which of the following sectors do you believe will underperform the market in 2021? And you basically had those four categories: office, retail, industrial, and residential. I suppose consistent with what the presentations have been saying, we obviously office seems to be the poor cousin in this, followed by retail, lesser industrial. Obviously industrial split between the logistics and the manufacturing sector, so interesting to see how that plays itself out. And by default, I suspect people have hope for the residential sector. So thank you very much for your responses. Interesting to see what people said. And we'll post the second poll based on Craig's presentation now, and we'll see at the end of Francois' discussion what you had to say about Craig's question. Just a big thank you once again to Craig. And now, I suppose for the interesting part of the afternoon, or not the interesting part of the afternoon, I should say, maybe a contrary part of the afternoon, where we always get to have Francois' views of the world, which are never the same as anybody else's views for some reason. But perhaps just to kick off, Francois, I mean, you've heard these two presentations, a lot of detail, some interesting numbers and some interesting commentary behind those numbers. What did you pick up in particular from those presentations?
Hi everyone. Thank you, Rob. And maybe my view is different, and maybe it shows how out of touch I am with the market. but so be it. I think there are a few themes that really came out of this afternoon. And I think the first issue is, and I think Craig also made the point, that the sector already had difficulties before 2020. And if you really look at it from an economic perspective, we've been in a cyclical downturn since December 2013. This is the longest cyclical downturn that we've been in since the Second World War. And I think, 7 years down the line where we've been in this downturn, and I think that what we are also seeing is that the sector entered 2020 already in a vulnerable position. And I think what last year did was to really bring out, I'm not saying this, the difficulties. And of course, we saw the presentation and what Eileen had to say about the income drop that we've seen across many of the sectors. But I think there's another issue to bear in mind here. If you look at the 2017, 2018, we actually got out of that pretty quickly. We were in there and out of there in less than 2 years, which also means that we never saw a major structural change in the property market. We, to a large extent, carried on the way we were doing things. And I think that that is probably one of the important issues here. The longer the stakes and the longer this economy remains showing a poor performance, the bigger the structural issues are that we are going to be dealing with. Now, Eileen's presentation was interested, and I completely buy into the polarization issue. I think that stock picking is going to be critical as we go forward. And of course, the types of properties. And I think that the point that was also made here is these refurbishment or reuse of properties. And I think we're going to start seeing that. And of course, the question is, who says that you only need retail in a shopping center? Who says that? Maybe we will see our shopping centers acting more like high streets with different uses. And I think it's those sort of issues that play a role. Craig, you made the point. I mean, this industry, if there's one big number in this industry, it's been the 8% escalation. Now, of course, very few, many are still trying to negotiate that, but I mean, the market is not there. So we are, if I can call it, the rules of the game. And I remember many years ago, it shows how long I've been in the sector, there were a few rules. 5-year lease, 12% escalation on net rental, 15 on op costs, and an IRR of 21%. And as long as those numbers, those were the numbers, you understood the market. And if you came up with something else, you were told to go and do your homework and come back. But I think those have all changed. And I think that the lease structures are also being altered. And I think this becomes interesting in the discussion. I think we've spoken about the issue of valuations. I think that will be with us for quite a while. But I think we're going to start looking differently at risk. You know, as the economist John Maynard Keynes said before the recession in the 30s, was that you can measure risk, but you can't measure uncertainty. And I think we saw here a typical example how we deal with uncertainty. Now, and that almost links me into the issue of the ESG. I mean, I'm just off a conference in Europe where many investors won't touch stocks without a strong ESG. And even if your ESG principles or plans are weak, the investors will start telling the board about ESG and how they'd like to see things change. And we've got to a point that we're not, I think, that far off, where you almost have a fiduciary responsibility as a board member to handle ESG issues. And I think just to touch on both presentations, I think that this will become very central to our discussion. We're going to shift from green buildings, where the start of the ESG debate started, into a much broader issue around government social issues and environmental issues. And so what I'm saying, and it's starting to come up, is that ESG issues will start finding their way into valuations. The depreciation of buildings that are not reflective of ESG principles, certainly environmental. And there's a great expectation that funds will have a zero effect carbon impact, and how quickly we reach that. So I think these are, again, structural issues that we are starting to see coming through the market. And I think the final thing I want to touch on, and then I'll get back to you, Rob, is I think we are testing the REIT structure on the way, not down sounds hard, but certainly on the downward phase of a property cycle. And we're seeing the impact that it is having. And yes, I've heard questions, is the REIT such a great structure on where we are now? Does it do what a company could do? So I think these are important questions that we are going to be asking ourselves. So my overall observation is, and I'm happy to talk, and then Rob, we can talk about some of the longer trends, is the structural impact. It's also the use. And by the way, when we talk of uses, I mean, I am amazed by the growth at the moment globally of data centers. And those data centers are not only for the Googles and the Amazons who need the hyper centers, but they are centers that need to be developed very close to the urban environment and in the urban environment to ensure that you have speeds that are acceptable. The only problem we have with that sector is that when you speak to people on data centers, they talk about megawatts of power requirements for centers and the addition of centers, whilst we are sitting here with load shedding. So I think that will have its implications as we go forward. Okay, Rob, back to you, and then we can see how we take that forward.
Thank you very much, Francois. I just want to see whether I'm going to go. Thank you, Francois. I was wondering how long it was going to take you before you mentioned Maynard Keynes, and the fact you managed to get him in on your first question, I was very impressed with that. But perhaps before we get into some of the longer trends, I mean, if you look at both the earlier presentations, I mean, what definitely seemed to come up there was the industrial sector. And what I found quite interesting is that, I think was in a lot of Elaine's numbers, was actually how well manufacturing had actually done, although the vacancies were high. And Elaine, please correct me if I'm wrong here. The vacancies seem to be high, but the actual performance of manufacturing actually surprised me. But Francois, before we get on to manufacturing and just staying in that industrial sector, the logistics sector, it seems to be doing so well, but the sort of economy seems to be under trouble or in trouble, etc. How do you explain that particular phenomenon?
Okay, I think what you really need to look at here is, again, I spoke of the structural changes of the property sector, but I think we're also seeing structural changes in the economy. And why structural? When you have frictional unemployment, if GDP pops up again, that space gets taken. But I think when you have structural issues is that you start seeing the obsolescence of buildings. So I think there are two issues that are playing. First, I think the existing industrials are trying to be as efficient as possible and are looking for modern space, just to get their costs under control. And secondly, and it's something which I might as well discuss now, and that is the growth of the e-retailing sector. I think let's not underestimate that role has. You know, I'm taking a bit of the view that where the car destroyed the department store and created the shopping center, In other words, you create a shopping center, you got everybody with a car to come to a shopping center. I think we have to ask ourselves whether the internet will do to the shopping center what the car did to the department store. It's always been about movement. It's about getting how you get people in the retail environment. But I think what also becomes interesting in the logistics sector, and I think I mentioned it in the data center as well, is that we are starting to see the logistics center moving into much more into the suburbs. I mean, you only have, just to take Takealot as an example, the Takealot stores that are opening up, the depots that are coming up, the data centers probably want to do the same thing. So I think it's going to become, it's not just the mega hubs or the mega industrial sector that you have to look at, but I think that the industrial sector is starting to get a segmentation of itself. The data centers have a segmentation at the moment. I think the logistics, you'll see starting to see that segmentation. So I think that you have to take a wider view than the one. And I think what it really also leads to, and I'll stop at this point, and that is that I think our suburbs are going to become exciting places. In the sense, and I saw, Craig, I think your last slide, you had decentralization. I think that between I liked the ad the other day of WeWork saying not work from home, but work close to home. And I thought that was quite interesting in the sense of, will we be working much closer to home with the neighborhood shopping, whether the co-working space is there, and the logistics sector and data centers all moving into the suburbs. And we're getting very clear pictures coming out of Europe and the US at the moment, where retailers are picking suburbs at the moment and saying, I want a standalone store in suburb X and Y. So it's not necessarily in the shopping center, but for those of you who've been to the United States, you will see that as you drive out of a city, there's a JP Penney and there's a McDonald's, all not in a mall, but sitting next to each other. And so that picking of catchment areas and suburbs becomes, I think, very interesting as we go forward.
Thank you very much. But Elaine, I don't know if you just have any ideas on that manufacturing component to piggyback on what Francois was saying there. I mean, it's slightly different sides to the industrial sector, but I did find those numbers interesting.
Those numbers are a little bit skewing in what they look like when you look at the manufacturing line by itself, because the reality is that most of the bigger real estate funds or the investment, guys holding property for investment have sold out of manufacturing. So it's a very small segment within our data set and within the market as well. So it doesn't have a huge swing. I think what it also does talk to is those funds that do still own, or those portfolios that do still own manufacturing assets, are owning really the top, the assets that are still producing well, with long-term blue chip manufacturing leases in them. Otherwise, they've discarded the bottom end, really.
Okay, interesting.
Okay, and moved towards the logistics, yeah.
Okay, well, thanks for that clarification, because those numbers were quite interesting. Well, they surprised me, I should say, in terms of seeing it.
Yeah.
Francois, you've been talking about structural changes. And maybe you'll speak a bit later on of any other kind of longer trend you want to speak about it. But I'm interested in this, we've also seen in terms of structural changes, the growth of prop tech. Yeah. And I must admit, we had some interesting questions from the participants when they were actually registering to come on this webinar. And the one, well, there were two questions. Really was, what is the role of technology in changing the real estate landscape? And then a related question was, where can technology add the most value to the real estate landscape? And so just what your views are in terms of prop tech and technology.
Rob, if we look at prop tech has been with us now for quite a number of years, and we've seen it grow. We're almost in the second phase. I mean, if you think of the initial prop tech, those were the spreadsheets we were using with a bit of data attached to it. And I think we are slowly moving into a world of, like many sectors, the digitization of the sector. And so I think that is where we're going to start seeing the movement. I prefer sometimes, instead of talking about prop tech, I prefer to talk of technology and property, because prop tech is one component of it. But I think where it starts becoming interested, either we're going to find ourselves where individually in the transaction say, hey, prop tech is good, I'm going to leave my commission at where it is, my costs have come down with the technologies and I'm better off. And we leave and we carry on, and there's a nice margin that is now created out of the prop tech world. But I think, again, there are a few issues here. Where it becomes interesting, and for those of you a bit more maybe in the residential sector, is where prop tech, fintech, construction technology, and GovTech and the government start meeting each other. Then it becomes interesting. And I think that becomes a world where we can start measuring properties, where, yes, I mean, how far can we go? Could we imagine a farmer in Limpopo for 2 rands buying a share? Some people will say, well, you can do that with a REIT in any case. You can get in at 50 cents in certain cases. But I think that how the transaction costs and your ability to invest in property and the ways you will be able to do so globally as well as locally, I think becomes interesting. I think that instead of saying that prop tech will take over the jobs of people, I think what will happen is that as a property practitioner, you will be working with your friend the robot. To expect a broker to be the specialist in town planning, in valuation, in many things. I think there we can certainly play a more efficient role. So yes, that's my view on prop tech. I think that we've got at least 45 to 50 companies in South Africa at the moment that are dealing with the different components of prop tech at the moment, and that goes the whole way from sales to data. You can put co-working space in there to some degree as well. Actually, what becomes interesting is that it's the techies that are some of the big property players will be those who are playing the tech game, and we're seeing that in Silicon Valley as well.
Great. Maybe to close off then, just one final question. I'm conscious of time, and I see we've had some great questions that it would be fantastic to get the panelists to respond to some of those questions, but maybe one final question to you, and talking about some of those longer term trends that maybe that you haven't covered, but also to pick up on a question that one of the participants put forward when they were registering. Asked quite an interesting one. They said, is COVID a disruptor or something that has just speeded up structural change in the real estate market? And in other words, does it just accelerate existing trends that were happening, or are there new trends that have been created by COVID?
I think that's a very interesting question, because I think many of the trends that we're dealing with now, first of all, I think they were already on the horizon. There may be a few that are particularly new. Did it accelerate some of that? Yes, I think there were discussions where if you had raised them in a boardroom, they would have said, well, nice thinking, and, we appreciate your thinking. And that would be the end of it. To have sat in a boardroom and say, hey, let's send all the employees home and let's do that as an experiment, well, it wouldn't have got you very far. And the big problem we have now, actually, which is interesting, is to get the people back. I've seen 1 or 2 organizations who are actually, they said, come back, and some people don't come back. Well, of course you can say, well, then, there are consequences of that. But look, broadly 3 things. I mean, if you think the work practices, co-working, co-living in the housing sector had already started. And I think this leads to an interesting point, that the property sector for decades has been selling GLA, if you want to call it that, space. I think what we're going to see is the selling of a service. And I think that property companies will find themselves over the years much closer to what hotel groups look like than necessarily. Yes, there is square meters, but what I always say, when I go to a hotel, it doesn't cross my mind that I'm renting 30 square meters for 2 nights or whatever square meters it is. I'm buying into a service. And I think that it will be interesting that whether companies will have a stronger branding, property companies, that you will know when you're at company X and Y, that brand will, I know when I'm at a Radisson Hotel, I know when I'm at thing. Sometimes I see the plaque of the management company in a commercial property, and then I start to guess who actually owns it. But maybe it doesn't matter who owns it. But I think it's going to be, I think we're going to start seeing that transition to a provision of an overall service, which also means that I think the owner will get much closer to the business of the tenant than in the past. I mean, some people have argued that if you do a retailing in China, the property owner can see second by second as items are being sold on the till. You know, it's connected to the property owner just about. You know, I don't think we take it to that extreme, but I think that level of integration between the user and the provider of space, I think will become a lot more interesting. Focus on service. I think we'll see, we've had the discussion on leases, and those leases could look very different with a stronger service provision. And then I'm going to leave it at this. I am certainly putting the bet that any property owner who doesn't start taking ESG seriously, I think will have a problem, both from the tenant perspective and certainly over time from the investor's perspective. And I think that we will start seeing the integration of that much more than we've possibly seen in the past. So all I'm saying is that the social and ethics committees, I think, have a big task ahead of them. Certainly a bigger task that they may have had in the past. And the link between that and what happens in the audit committees and investment is going to become critical over the next few years.
Fantastic. Francois, thank you for that insight. And I think a lot of your views are relatively but consistent, what we're seeing coming through with the presentations, etc. So and clearly one of the big sort of topics of the afternoon seems to have been the ESG story seems to be one that is increasingly going to become more and more important. Folks, before we open up to the panelists to start answering a lot of the questions, I just thought it would be quite interesting just to see the results of the second poll. And so perhaps we can post that second poll now and just see what everybody's views were. So the question was, do you believe that the performance of SA REIT sector over the next 6 months will either 1, improve, 2, stay the same, or 3, worsen? And I'm afraid maybe it's in the colors of ESG or something, but unfortunately green kind of won out on that. Interested to see a relatively large number of people suggesting it would remain the same. I thought it would be more evenly split between improve and worsen. So an interesting kind of view on that. Folks, we have one last poll that will be posted now, just in terms of picking up on some of Francois's inputs. And we'll but we close, we'll post that poll. I suppose this is the interesting part of the afternoon, or the more interesting part of the afternoon, I should say, is where we just get some responses to a lot of the fantastic questions and inputs that we've had this afternoon. So thank you very much for navigating the technology and for putting your questions forward. Perhaps just to kick off, and I'm sort of going to go just from the beginning towards the end and pick up, and there'll be some questions that are related to each other, so we may combine 1 or 2 of those in the interest of time. But Craig, I think this is, or actually both to Craig and to Elaine, etc. There was one here that someone was particularly interested, Marvin was interested in understanding the correlation to the physical market and the listed market in terms of property valuation. And if I can tag another part onto the end of that as well, because another participant asked what would be the impact of rising interest rates on the valuations, etc. as well. So maybe you can sort of kill 2 birds with 1 stone, and I'm happy for maybe Craig, you want to give your input and then we'll follow up with Elaine.
Yeah, that's fine. So, I mean, certainly one can track, the correlation between listed prices and the physical market. I mean, it's quite clear that there's a big disconnect, and there's certainly a lag. So I mean, one wouldn't expect the physical market to adjust as quickly as the listed market, and also not necessarily to the same extent, because it is something, as Eileen mentioned, we don't have an abundance of transactional data to support adjustments in pricing, and pricing in the physical market, does take longer to sort of come through. So the listed market, it would be an indicator of where a collective of investors who invest in REITs believe sort of asset values to move to over time. But again, there are nuances, because not all companies have the same leverage. Leverage has a big impact in terms of share prices. Sentiment plays a big part, and that's why I think you can find the listed market both on the up and the down. I mean, we had 10 years where the listed market rallied at a rapid rate, and companies were trading at significant premiums to their NAV, whereas the physical market does tend to be a lot more sort of smoothed. But I do think the expectation is for further downward adjustments, not for all property types and for every property in a portfolio, but certainly on average further downward pressure on valuations. I think in terms of interest rate increases and its impact on property values, I guess that's going to be a function of where one takes a view on long-term inflation, and also the liquidity that's flowed into global markets, and that's starting to sort of also flow into emerging markets. So I think there's probably more a likelihood of rates remaining, even in an SA context, lower for longer, just given what's happening globally, and inflation being expectations sort of also being anchored lower. The counter is obviously the SA risk premium. I mean, I think that's where you could find bond yields potentially ticking upwards based on how the fiscus looks and the sort of political economy.
Right. Elaine, your views on that?
Yeah, I mean, very much what Craig is saying is he's absolutely right, and I'd agree with that. And I think maybe just the good run that the listed funds was making pre-2017, when things started to tank a little bit, was really often just generated more by other income sources rather than just the income generated off the assets by themselves. So, that correlation probably went out of sync, and maybe we'll see that come back a little bit more now that the income is more closely aligned to what's coming off of the assets. So, it'll be interesting to watch that going forward.
Okay. Thank you. Getting back into sort of the real economy, there was an interesting question with respect to what's going to happen to shopping centres, because globally we've seen the big move away from your kind of shopping malls, etc. But we know South Africans love their shopping malls, and we've all been cooped up in our houses for too long. And the sort of question was, once we're allowed out of our houses again, are we going to find South Africans drifting back with the malls? Francois, you got any ideas on that?
Okay, Rob, thank you. I think I've shared already some of my views on this. And, if you go back into the history of property, from the first industrial revolution, second, third, what have we done? We've shifted from the marketplace in the village to the shop in the city, to the department store, and from there we moved to the shopping center. I think it would be naive to argue that the world is going to stop at this point. As much as we may want to and say this is the shopping center is the ultimate answer into the future. I think we've got to accept that retailing will change. I think, Eileen, if I'm right, the performance on neighborhood shopping centers and community still seems to be holding up. I think what we will also start seeing, and I'm raised the point, it's this walk in and walk out. In other words, self-standing store. And I think it's an issue that we're starting to see globally, where also your retailers, like I said, will target very, very carefully. Of course, the question is, what is retail space? I mean, should you be looking at the logistics sector as the shopping center of the future? I mean, when I'm talking from a bricks and mortar perspective, in the same way that we've moved from the department store to the shopping center, there will still be a bricks and mortar, but will that bricks and mortar start looking quite differently? And I think that that's the question that we will be asking ourselves. But the point I want to stay with, we still have some marketplaces from the very first. We still have some great department stores around the world. We will have shopping centers, those who find their way into the future. The best ones will be there. What happens to the less, and there will be casualties in this, as there's always been, you know, from an economic, you know, it's also that constructive destruction. That's what economies are about. Things change, things become obsolete. But I think what could also be interesting is not to say, well, it's the end of the shopping center, but the point that I made earlier, is there a changing role for the shopping center? And I think that's what I'm also asking myself, is does it become our new high streets? And as I said, we've often taken a view that with tenant mixes, we need the tenants. Can we mix different uses in a shopping center? Which we, to some degree, we've done. We've had the banking malls in there. We've had, you know, we've had banks in shopping centers. That's not particularly new. But can we create an environment that is attractive and that has different uses, maybe with a residential component? And then I think the one sector maybe that we haven't also spoken about, and I think it links into this, I think the next few years is also going to be about the residential property sector. If I just look at the Urban Land Institute in the United States, which I follow very carefully, of the first top sectors, 10 top sectors, 7 of them are residential. Now, some may argue, well, it's the end of if universities start going online, it's the end of the residential student market. Well, I would argue just the opposite. If tomorrow we had to bring back all our students who are vulnerable from a technology perspective in South Africa to our campuses, we wouldn't have enough rooms, nowhere close to it. I think that there's going to be, yes, students who may well be doing their lectures out of their rooms, which means the rooms have to cater and the Wi-Fi has to be great. And I think that by itself could still create interesting developments in the suburbs student environment that we have. Okay, I think I'm digressing a bit, which I tend to do. But,
Andy, do you want to add anything more on there with respect to sort of the shopping centers and the sort of the future of the shopping center?
You know, I think that there's no question that shopping centres, particularly the big ones, are going to have to look at how they re-let some of that GLA that's going vacant, because the reality is that it's becoming, the affordability factor for tenants is growing at the moment, you know, substantially. And so those smaller tenants are dropping out. And what do we actually do in those big GLA, you know, the big shopping centres that are 160, 170,000 square meters? That's a lot of space to fill with new retail tenants. So, you know, and then coming back to this ESG story, so how do they fill it? You know, we sort of fundamentally go back to what we know. Do we fill it with an office? But what about filling that with a social sort of aspect? So it ties into those REITs' social goals that they're trying to reach, rather than just purely renting out space again to another type of tenant. So, you know, it's sort of flipping this whole thing on its head and looking at investment again from that new lens. And this new lens of ESG gives us such a nice way of thinking about things outside of the financial that's always driven all investment decisions up until now.
It's an interesting point. I mean, what somebody once pointed out to me was that the location requirements of a shopping center are the location requirements of many other types of uses. So for instance, because they work on the catchment area principle, anything that works on having to fit into a certain catchment area, you could actually convert that retail space into. So for instance, schools works on a catchment basis, etc., etc. So I think we are going to see some interesting things happening in that space. Moving on to one of the other big themes, and we started to touch on it, and I Craig spoke about it, Francois spoke about it, and there's been a number of questions that have come through is about residential. And then there seems to be sort of different views around this, because we're seeing sort of the residential story. Craig, you were talking about it, about people moving out of expensive residential spaces well located because they don't need to, etc., etc. So we're seeing that shifting happening. There's a big talk about the office conversions, or the, maybe office and retail conversions into residential, etc. But one of the participants actually made, I thought, a very valid point, saying yes, that's correct. But we're also seeing high levels of unemployment, etc., happening on the back of COVID, etc., etc. So household incomes are being stretched, etc., etc. So how do we overcome the affordability issue in this residential game? And I think you did speak quite a lot to that, Craig, but do you want to add anything more with respect to the residential story?
Yeah, sure. So I mean, look, that is a very real issue for overall sort of aggregate demand. I think, certainly what we have seen in terms of our interactions and sort of, with various stakeholders, I mean, it's quite clear that the interest rate effect and significant reduction in interest rates has sort of brought a new buyer, so not necessarily from a rental point of view, but, individuals and households that were predominantly, renting have sort of come to the market, and, it seems to be quite buoyant in that space, anywhere under 1.5 or probably 1 to 2 million and under 1 million. I think, from an overall affordability point of view, I think the reality is that the challenge is going to remain. I think it's a case of developers and sort of industry participants finding solutions to provide accommodation at an effective demand where they can deliver the product. I think no one's yet, and again, I'm by no means an expert in that space. It's obviously there are a lot of sort of bottlenecks and challenges, but I think that's where the big opportunity potentially sits in. But we certainly the private capital in the listed sector hasn't really played in that sort of that sort of space. It's always been perceived as sort of high risk residential as a whole, not just affordable residential. That is seemingly changing. I mean, certainly the experience overseas is that multifamily and single family housing is a massive component of their sort of real estate markets. But maybe also just quickly touching on your other question around retail. I mean, I think I haven't traveled extensively into Asia and China, but one can quite clearly see that there is a space for for physical retail. Their e-commerce penetration is substantially higher than we have in South Africa. But it's a case of having the right type of retail and the right tenants in that space. And touching on Eileen's point, in terms of alternative uses for that space. I mean, for example, in high dense catchment, in well-located shopping centres, one could potentially start seeing storage operators, operating from that platform. Or, I spoke around last mile logistics. Someone's going to kind of get that right at scale, and certain retail pockets of space could fit quite well from a last mile logistics point of view. I suppose the question is, how you're probably still going to need to see rents and vacancies increase to a point where landlords and the market starts to actually take that seriously and look at those solutions.
Just looking at sort of some of the other questions that come through, and they're speaking quite a lot about, one, the repurposing of that space, and it could be in retail going to co-working, etc., etc. And I'm just seeing with the poll results coming up here, which is interesting. That sort of co-working, etc., is seen as being quite a big trend that people see continue going forward. Of course, if you move across to other uses, for instance, residential, you change the lease structures as well. I mean, you said that leasing game is going to change, and I think both you and Elaine sort of were speaking around that, etc. And obviously, this change of uses changes what the leasing story is going to be as well. Elaine, there was a question regarding pricing, and they said perhaps can you talk to the two major factors that investors are taking into account, especially with respect to around kind of pricing of those investments. Any views on that?
So I think that what investors are trying to understand is what is the right price for a building. So, you know, if you and is it being, you know, if we're rebasing the valuations of assets at the moment, how much further do we need, or, you know, are we at the bottom, or how much further do we need to go down? So I think that's what investors are sort of looking at. How much steam just still needs to get taken out of the market to sort of reset that base. And that's one of the big things when we talk about repurposing of buildings. You know, property values have to be at the right point so that once the capex gets spent to repurpose that building back into something else, which often costs a large amount of capex, the property price has to be right to start off with, otherwise the yields don't work. So until, to Craig's point, that we see big vacancies coming through and enormous rental growths going backwards possibly, you know, that's going to be the push then, that the values will then come down and then we can start repurposing. So it's, you know, one thing begets another within this market. So I think that's where investors are looking at. Are we going to, how much rebasing still needs to happen in the market? So we've saw, you know, 0.5% come down over the last 6 months to June 2020. Are we going to see another 5% come down? And where might that stop before things grow again, or prices are right for either sales to try, you know, so we get that liquidity and sales to start happening, or people really start pouring capex back into those buildings to change the structure and change the purpose of the building fundamentally.
Interesting. I mean, maybe, and I think, you know, there's been a lot of questions around but the leases, etc., and I think we've responded quite a lot to that. Perhaps the last theme before we start to wrap it up and pull it to a close is, you know, there's been a lot about restructuring, repurposing, movements into the suburbs, etc., and there's been quite a few questions that have been put forward here about, so what is the role of the state in that regard? How do we need to change some of our institutional arrangements to facilitate some of these changes? I think Dion in particular was wondering whether that was going to be a hindrance in terms of our ability to respond to these new demands. And then perhaps related to that is looking on the supply side of the market a little bit in terms of what's going to happen with building costs and you know, the supply side costs in this equation. And so perhaps you can sort of respond to those two. And I'm actually going to start with Elaine, because she's always seemed to be on the receiving end of long answers by Francois. And then I'll end with Francois on that one here.
So just in terms of the role of the state, my thought was when we were talking about affordable housing is how do we make an investment case for affordable housing? Because the reality is right now, while we may have an enormous shortage of houses in South Africa, the affordability of that housing, given the pressures of their market and the GDP growth and the unemployment, it's still not affordable to large segments of our market. And that segment of the market that can afford it is probably dropping at the moment. So a lot of our clients that we're talking to that do operate in that residential space, they are seeing increased vacancies, and they're seeing, you know, on the ground, they're talking about guys doubling up. So with, you know, it was maybe a single let unit where one person would stay and people are now sharing that, or they're moving back to the township because they can rent a back room, whereas, you know, so there's lots of other options out of that as unemployment comes through, or people don't necessarily need to be in the inner city anymore, or to be able to access Sandton easily, they can now work from home. So there's lots of changes in that market, and I think the state is going to have to play a much bigger role in making the investment case for investors to come through, maybe through social housing or some sort of other, you know, tax benefits or something for them to be able to supply that housing in a way that the investor still gets their cut and provides acceptable housing for people in the short term. And maybe that can play out over the longer term when, you know, the economy turns around or whatever. I'm sure Francois has lots to say about that.
Right, thank you. And I think you're right. I think it's some of those kind of supply side cost drivers that one's really going to have to look at to ensure that this affordability challenge is actually addressed. Craig, any views on that? You did mention some in your presentation, but be interested if you had any other views on that.
No, I mean, I think Eileen's covered, covered a lot of the bases. I mean, I think maybe just one sort of comment, but again, not as someone who is a developer or or who knows that space particularly well. I mean, I think, there are other markets from what I've sort of, looked into at a very high level where, one can, provide reasonable quality accommodation, but I guess it's there are other I suppose vested interests and bottlenecks and challenges to potentially bring in some of that alternative housing, which could be fit for purpose, but for various reasons, whether it's culturally not sort of the norm in SA or accepted, or whether they're entrenched players who won't support that, or bureaucratically it's too difficult to achieve. So I think ultimately you need a framework. I think driven top down to kind of address it.
Okay, fantastic. Francois, to close out on this question, and then I think we need to wrap the session up.
Okay, I'm just waiting. Yeah, okay, I'm just waiting to be live. Look, I think that if we look at the housing and the role of the state, I think that cities are working more and more with more flexible town planning schemes. We're looking at overlay zone. Will we have an ESG overlay zone? If your property is green and it plays a role and a social role, will you get that extra bulk as a result? Cities have a role to play around this. And I think that as we move out of the COVID-19 environment and as we get our CBDs going, I think it's going to be very important that we have the flexibility. And this is not just the flexibility for the owners, but also flexibilities for the user. If you have to wait months before you can get a restaurant license to open up, it's the user who just can't move into the building and start doing what we want to do. So I think there's concern at the moment that with some of the empty space in our CBDs, I'm thinking the Cape Town market that I happen to know a bit better, who will be in those properties along Bree Street, Long Street, who will be moving in there? Yes, if there's a cash flow, you're going to pick up the first tenant. So I think that that role is going to be very important, not just fill the space, but how we fill the space in a way that promotes the cities. And then finally, just into touch with that, with housing, I think that we need to change the housing game in South Africa. If we want to get serious private money into this sector, we can't go house by house, 40 square meter house by 40. We've got to build at scale. And that scale will offer us an asset class that is very different. So, Rob, I'm going to keep it short because we're running out of time. I think we're over time already. So,
absolutely.
And then, just hand back to you. Yeah.
Great. Well, thank you very much. And I'm hoping that we've managed to capture most of the questions and comments that came through from the participants. Thank you very much for all of that input. I think we've more or less responded to the vast majority of them. Just before I hand over, just to finish off with the poll quickly, which was the last one, which of the following long-term trends do you think will get the most traction? Interesting, working from home, not. Interesting, co-working, actually didn't do too badly at all. Perhaps picking up on what Francois was saying about prop tech. Is there a little bit of hype in that as opposed to some sort of substance? And I think in particular coming through strongly in these presentations has been the repurposing, I should say, of buildings, and obviously the ECG story as well, which has been consistent. So thank you to everybody for inputting their views on that and some interesting results. From my side, I would just like to say thank you very much to Elaine and to Craig. Fantastic inputs, and I can think if you can see from the questions, etc., that were asked, there was a lot of interest around this matter as well. And thank you to Francois as well, and to the team behind the scenes, all the technical people that helped to put this together. A huge thank you to Roxanne and her team on that side as well. Francois, before we close out, would you like to just say a couple of words? But thank you very much to everybody on my side. Thank you.
Thank you very much, Rob. Rob, thank you very much. And I would also like to thank everyone who participated in this afternoon, because I'm not saying that I've misused you all, but you've certainly helped us determine our research agenda for the next year, what our students will be looking at. I think we've got some interesting things that whether around, again, technology, social, environmental issues, how we be prepared for the horde of our students arriving. I think we'll have a number of dissertations, how you changed your decision making over the last year, what you did, how you did it. And so the question is, will probably be flowing. So thank you up front already for supporting the new graduates as we come through this. But yes, with all seriously, I think there are big issues that we are going to be dealing with as URERU in the next few months and years going ahead. I think it's a fascinating environment. I think that the property practitioner comes to the fore here. The selection of properties, how we manage our properties, fill our properties. I think these are all critical issues that come to the fore. It leaves me then to Rob. Thank you very much for facilitating, for keeping us all under control, and me especially, which is sometimes not that easy. So thank you very much, and for our guest speakers for putting the time and effort into these presentations. These presentations don't happen overnight. And what I always say, you know, in the behavioral finance work that we do, it's not just a presentation, it's years of experience that flow through these presentations. You know, it's not just the graphs, it's the ability to handle the questions that we've done. So I think thank you for sharing your years of experience through your PowerPoint presentation. And then again, thank you very much. So Craig and Eileen, thank you very much. And then a great thank you again to the UCT team, who are absolute specialists for these sort of interactions. I'm not doing here their marketing, but if you need people who know how to do this and where you have individuals, thank you to the IT team behind this for keeping it going. And thank you very much also to Eskom for not giving us any outages, and that you were all able to follow the 2 hours that we had. So thank you very much for being with us. And I think on that, we can close.
Thank you, everyone.
Okay, good. Anyway.
Thank you.
Well done.
Hang on. Francois, I think you're on.